Portfolio Builder members, welcome to your February 4th evening briefing. If you're getting this alert late, subscribe to our YouTube channel, click the notification bell. You'll get it automatically from YouTube the second it comes out. We're going to be covering our free buy and hold portfolio, which does not take advantage of the options market. Great for smaller portfolio sizes who want more risk and more reward. We're also going to review our more advanced program, where we trade options. The goal is to make safer profits with far less risk. The only way to achieve that is by owning put options below our assets and then selling covered calls for income. So I'll cover both in terms of what's going on big picture. Now, there's certain things I cannot say on this social media site. Can't even name them. Massive censorship is happening. I can only say some things in our Zoom webinars, which are for our options clients. And again, I do offer a free 7-day trial. If you click the link in the right-hand corner, you can sign up for our email list and get content that doesn't have to be really censored down to avoid problems with losing our account. Okay, so what's going on? $250 billion was injected by central banks this week. $180 billion from China and another $90 from the United States, so it's just over $250 billion, but who's counting? That's a lot of stimulus. In fact, since the rally began after the yield curve inverted last year and the phase one trade deal was on the table, we only grew our balance sheet by $100 billion a month. So to see $250 billion flow into the banking system in 48 hours is pretty remarkable. So certainly you can understand why SPY was up this morning, as well as emerging markets, as GDP has crashed from 2.9 to 2.1 in the U.S. China's on lockdown. The first death in Hong Kong of a 39-year-old was last night. So here's my key factors to watch. When will China open up markets? Japan has 20 cases. The USA has 11. The exponential growth rate is about 6.5 days. So I'm only really worried week over week what the change of cases is in Japan and USA now. I don't believe China will show more than a few thousand cases a day. And for them to be showing exponential growth, we'd have to be at 10,000 a day by end of this week and 100,000 a day by next week. And so right now they're at 20,000 cases, and that's probably severely less than the real fact. In our portfolio, in the buy and hold, we're long 1 share of SPY, 2 shares of TLT, 2 shares of GDX, and 1 share of Yang. And again, just multiply that. So if you had enough money to buy 100 shares of the SPY, you'd have 200 shares of the TLT, 200 of GDX, and 100 of Yang. Yang is the inverse ETF of the large caps in China, which I believe will be showing some significant slowdowns in sales and revenue growth in the next quarter. So we want to be short their equities market. Now, in our options program, we're doing this with an inverted or a bearish option caller, which gives us a unique ability to have a 10-to-1 risk to reward ratio. You buy the Yang and the market goes against you, you're going to have a little pain in your portfolio with our buy and hold strategy. But if you buy the highly liquid ETF emerging markets and then sell an in-the-money covered call and buy an in-the-money put, you can get a great setup. And in our trade today, we risked $25 to make $275. So it's actually more like an 11-to-1 reward versus risk. Now in our buy and hold portfolio, we've had some great returns with low volatility, mainly because we have half our portfolio in the SPY and half in the TLT, which is the treasury market. And those typically, when one goes down, the other goes up, and vice versa. And as long as you know the central banks have room to cut interest rates, there's really not a whole lot of risk of being long both of these assets at the same time. Now the problem is we're coming to the end of rate cuts because we can only go from 1.5 down to presumably 0 at the effective lower bound. So we have at most 6 more rate cuts before the Fed is out of ammunition. So what's going on in the portfolio? Well, in the buy and hold, again, we're long the SPY, long the TLT, and long GDX gold. and we're short China by owning the inverse ETF Yang. Now that's a 3 times inverse ETF. So while we would normally have 2 shares of emerging markets for every 1 share of SPY, I have dropped that down to 1 share of Yang relative to 1 share of SPY. So we're not keeping that 2-to-1 ratio. In our options program, we're playing it much more safe. If you believe in this rally, good for you. Trump has State of the Union address tonight, and $250 billion was just pumped into the markets to keep them alive. So if you think that's healthy for stocks, good luck. We're bullish, but with put options right underneath the SPY. That means if there's a big sell-off, we're going to see our TLT jump and the SPY kick in with the put. So we have a $3, what I call tight bull option collar on the SPY. That means we have a $1.50 maximum downside risk from where we put our put, and we have a $1.50 upside cap on our potential profit. So it's a $3 wide option collar that we're currently in. That's at a maximum profit as of recording this. We're naked, the TLT and GDX, although I will look to buy some puts as soon as I see those leap, which I believe will happen in February, alongside volatility in equities. And again, we remain short emerging markets with a bear option collar or a inverted option collar that has a 10-to-1 reward to risk ratio. Now, what am I looking for to change positioning? First of all, China has to resume business. Currently, they continue shutting down cities, blocking off transportation, turning gymnasiums and stadiums into hospitals, building hospitals. And so we really don't know what's going on over there. I do want to point out with our more conservative strategy, trading these same assets but with options, we've only had a loss of 1% month over month in 14 months. And this strategy actually will do much better in a bear market or a flat market. So we've done very well in a bull market, and I think you're going to see as conditions continue to weaken, as the slowdown from China catches its way around the world, you'll see this option-based portfolio is extremely efficient at protecting capital and generating return. So again, a little bit less total return in this option-based strategy, 14.8% last year, and 1.2 in the December crash. If we look at our buy and hold portfolio, you had to actually have a 2.6% loss in December, being long the SPY and the TLT. You had a loss in May of 0.8, and you had a loss in September of 1.6. Now, either way, what we're doing, whether it's buy and hold or buy and hold plus the options on top, I guarantee you it's more intelligent and safer than what you're doing in your portfolio. And that's because we have the SPY TLT combination, which makes it extremely hard to lose capital. And that, again, comes with the caveat that this works as long as the Fed has ammunition to save markets by cutting interest rates, which makes money cheaper, and then they go into quantitative easing to support the bond market. Okay, so let's look at the top news charts and what's affecting our trading decisions. This first chart I want to look at is the SPY, which did have a massive jump higher. So just from yesterday through today, we saw a massive gap opening from the futures market. This has been the way the banks have been manipulating the stock market. We're not seeing it trade so much during the trading day. Instead, they go bid it up in the futures market, which makes all these prices gap open higher, which is not necessarily a healthy way for the market. My expectation is we are going to be having a lot of trouble getting beyond this resistance line until the coronavirus is really contained. And assuming that China's slowdown doesn't impact the rest of the world, we're operating with very little data from China, and most likely that will continue to do so. So we can keep a close eye on the price of oil, the exports and imports from China, and rely on that information to get a better idea of when China is going to be back to full throttle. We can also look at which cities are remaining shut down and restrictions are being imposed to try to contain the coronavirus, which, again, may be much worse than they've reported. Now, if you've been following my channel, and I hope you'll like and comment on the video, it helps us with our rankings. Subscribe, click the bell so you get auto notifications. My prediction last week was that China had created a system that would stop the virus from looking like it was growing exponentially. And so they just simply control how many test kits each hospital has, and they can essentially say, okay, no more than a few thousand cases can possibly be diagnosed by that limitation. So sure enough, the numbers continue to grow by a couple thousand a day. And again, for this to be growing exponential, we'd have to be growing at about 5,000 a day as of yesterday and approaching 10,000 a day by end of week. So rather than focus on that, I think we're going to be better off looking at some of these other countries. Now, they have jumped just today, so that's alarming. But just to keep in your head, by Monday, if Japan hits 40 or the US hits 20, that will be an alarm bell that this is still growing rapidly and out of control. Now, to see Singapore jump up to the number 2 spot was also alarming. And just after another refresh, now Thailand has jumped up even higher. Now, Singapore, Thailand, Hong Kong, South Korea, Australia, Germany, these are all huge economies and certainly can create some selling in the markets. But to be bearish on the U.S. equity market, really, it may have to hit it home to really scare the biggest money managers in the world. So the biggest GDPs, again, are U.S. first, China second, Japan third. So I'm now really concerned about Japan and the United States showing exponential growth week over week. Now, to give you a feel for where we were at just this morning, they're all going up. So Japan was at 20, Thailand was at 19, Singapore 18, Hong Kong 17, South Korea 15, Australia 12, Germany 12. And again, just several hours later from this morning through current, now we're showing Thailand at 25, Singapore at 24, Japan at 22, Hong Kong at 17. So I'll be keeping close track of this daily. To keep your life simple, we're looking for these numbers to double every 7 days. As long as they do that, there is trouble ahead from the coronavirus, which means we want to be protective of the SPY and let our TLT run wild, as that's going to predict a slowdown in growth, which causes the central banks to cut interest rates, which drives the TLT higher. Now, if the worst case scenario happens and this virus does grow exponentially for weeks, months, this is the trading bands I can see the TLT trading between, and you can see it's exponential, and this could go significantly higher from here. In terms of giving it some perspective, the threat of a trade war with China drove us to 148 on the TLT. And after we supposedly had resolved that and went into not QE, we saw it drop as low as 135. But clearly the market figured out that this was not resolved and that there was conflict ahead. We saw first the attacks in the Middle East, and now we're seeing that there is a vicious epidemic/pandemic spreading from China. So my new targets on this, assuming we do effectively end up having to cut interest rates all the way to 0, and assuming they spread this out, say, every 3 months, this could last for a year and a half and potentially drive this somewhere between 160 and 180. And now again, if the German yield goes below 0, that will give the cover for the Fed to actually go below 0 on rates, on the federal funds rate, which could potentially drive this even higher. And so essentially, here's what we're looking at on the TLT. Now, entering the year, we thought we were going to have a period of peace and normalizing of rates in terms of a range between 112 and 128. But 2020 is starting off with firework after firework, And unfortunately, due to the exponential growth of the coronavirus thus far, I don't think it's safe to bet down on the TLT anytime soon. So most likely I'll be long the TLT for much of February. And again, I'm looking for China to resume business. Right now it's continuing to shut down cities, continuing to instruct corporations to work from home or even take time off. We're seeing business owners get a free month of rent, on and on and on. So we really have no idea just how bad it is in China or what impact it will have on the global economy. But surely what we can estimate is it will create a slowdown and that the central banks will react to this by cutting interest rates. That makes the cost of money less expensive. It makes it less beneficial to save because you're going to get paid less on your savings, and it incentivizes spending. So that helps boost GDP, helps boost spending by corporations, and helps to keep the economy rolling. So what's the effect of that? TLT travels higher. Here's the emerging markets ETF, which is not as concentrated on China as the Yang ETF. It's more of a broad Asia product, but a huge percentage does track China, specifically Alibaba and Tencent, two of China's premier companies. I just want to point out, look at the crash they caused all on their own in 2015 from misallocating capital. And they only got out of that by spending trillions of dollars trying to build more stuff that nobody wanted to use, which came in the form of multi-billion-dollar airports that are empty, billion-dollar highways and bridges that are rarely used, ghost cities the size of New York, and some 15 million condos they've built that are that have no renters. They're just sitting there half-built, and they are starting to erode. There's lots of blogs all over YouTube that show this. So throw in a pandemic and the effects of a trade war still being felt in China. Lots of manufacturing ditching China. They have a lot of pain, and you can understand why they went and injected a desperate $180 billion into their markets. And what did they get for that? They managed to stop a crash today after having lost 10% of its value already in 2020. So my expectation is severe downside risk for emerging markets until they're back to normal operations, which doesn't appear to be anytime soon. So we'll continue to bet down on emerging markets until they're back in business, 1. 2, we stop seeing exponential growth of the coronavirus in Japan and the United States. So key number next week is 40 cases by Monday in Japan and 20 in the United States. If we see that, then I want to remain long the TLT. I'm still bullish on the SPY. I can see a lot of money just ditching Asia and thinking U.S. stocks are safe. So I could see some flows into that. And again, so our general positioning is short emerging markets, long the TLT, and long the SPY. Now, if you have the luxury of using options, you can add a whole lot more precaution and safety and take advantage of both sides of the option market. So again, if you haven't yet taken our free trial in the right-hand corner, click that, take the trial. You'll see how we can safely generate profits, how we've had only one losing month in 14 months, and essentially had an insane risk-to-reward ratio for hundreds of clients following these trades over the past 14 months. Plus, you get a daily live webinar where you can meet our team and trade alongside us. So as far as how low could emerging markets go, well, just in the 2015 crisis, it crashed all the way to 30. And things really have not gotten better, but worse for China over the last half decade. So we'll just see how low it goes before buying comes in. If you go back to the 2008 crash, I think that might be too low, but you can see that did crash all the way to 19. Now, if you add in that the United States is going to ban investment from 401k and pension plans into these type of assets, remove it from different index products, well then sure, you could see it hit much lower than 30. But right now, the U.S. and China are still working in a cooperative manner and not in a antagonizing manner, which I expect can last through 2020, through the election, where I believe we'll see some more tensions, and phase 2 of the trade deal starting to be negotiated. Okay, here's a look at GDX. This is the gold miner ETF. And again, I've really zoomed out. The last time we did rate cuts was in the '08 crash, and that wasn't bullish for gold. But when we came in with QE after rate cuts, you can see stocks and gold miners rallied up. But during this period, gold miners significantly outperformed. And so you got to ask yourself, are we in a period of quantitative tightening and raising interest rates, or are we going to be in a period of lowering interest rates and doing quantitative easing? And so it seems we're actually in a period of doing both, rate cuts, QE, and something new that the markets aren't quite as used to, which they're calling repo. And so general trend is that all central banks globally are having to deal with big government deficits. And to do that, they have to print money and increase the money supply. And as the amount of gold is slowly being mined, we're seeing spot gold spike. Here's your spot gold chart. And again, anything over 1,500 is extremely profitable for gold miners. In fact, anything over 1,400 has plenty of profit. If we get below that, then we definitely want to be concerned and probably short gold, but I just don't see that happening as we have deficits everywhere. We have massive amounts of money being printed, and rates are likely to go lower, not higher. So in general, spot gold is above 1,500, and it costs gold miners less than $1,000 to mine gold. So until that stops happening, gold miners are going to make big profits, and we want to get a piece of that. Now, my expectation is for, as long as the coronavirus is driving the headline risk, that the key response will be lowering interest rates. So that's somewhat bullish for gold, but perhaps the big fireworks happen in 2021. So I think in 2020 we might be stuck in this red band, which you can see has some good growth for us, not nearly as much as if we went hyperbolic. And that's where you can see these yellow lines starting to really potentially play out. So again, I think we're going to go well beyond the price we saw in 2011. And this is just because we're trapped in a debt bomb. The governments have to create more debt each year to keep their GDP up. And until we have inflation, they're going to keep doing this. So as soon as we have inflation well above their 2% symmetric target for a considerable amount of time, that's when we can start worrying about gold. But right now, that's nowhere near the future. So again, I would expect us to trade around in these bandwidths in the near future, which is still very bullish and good reason to be long GDX. And then once we go into real QE, which could be in 2021, perhaps in Q2, we might look out for some hyperbolic moves where we'd go into these yellow trend lines. Now, ignoring the news flow and perhaps a pandemic killing huge chunk of the earth, what else would we want to happen to be bearish on U.S. equities for more than a few weeks at a time, or even a few trades at a time? Well, this ETF has to crash. This is LQD. It's your investment grade ETF. The higher it goes means there is cheaper credit for Microsoft and Apple and all those top S&P 500 companies. And really, we're talking about like the top 25 to borrow for cheap and buy back their own stock. So they don't need revenue growth. They don't need sales growth. They're just going to borrow money for cheap, buy back their own stocks, which removes outstanding shares, and then your earnings per share go higher and higher, justifying bigger market caps and higher stock prices. So LQD is at all-time highs, meaning it's never been better for Amazon, Microsoft, and Apple and Google to borrow. And not only that, they have record sales back-to-back with very few disappointments. Google's was a little bit of a disappointment yesterday. Facebook was a little bit, but the rest of them are coming in with blockbuster returns in the U.S. Now, usually the weak die first and the strong live on. So perhaps HYG is a better indicator for problems ahead in the U.S. stock market. This represents your Russell 2000 companies or your junk bond fund between HYG and J and K. Most of the money flowing into the corporate bond market in the junk bond space is through those two ETFs. They're not at all-time highs by any stretch, and they never did rebound since the China crash of 2015. But they are staging a significant rebound and show very little risk. So Russell 2000 companies may not have next to free debt they can borrow to buy back their own stocks, but they still have a relatively cheaper option than they did just a year ago. So this is all pointing to a strong U.S. stock market in the foreseeable future. Now in this chart, we're comparing the U.S. 30-year Treasury yield against the German 30-year bond. And they're the ones that were famous for selling negative debt. Imagine you agreed to loan Germany, say, $1 million for 30 years. And at the end of the 30 years, you will have lost about 50 basis points, or less than 0.5% per year. Just not a very good deal. Why would you want to loan Germany money for 30 years and lose a tiny bit, not a lot, but a tiny bit for 30 years? And so the only reason people are buying that bond are to speculate that they will have further trouble and have to cut rates even lower, and that they will go into a period of QE to vacuum up all these worthless bonds, which means you can flip your bond in the short term for a capital gain. So we can see ever since 2020, when this whole outbreak began, that the green line has begun selling off, representing yields going lower. And again, this has been the best leading indicator. We're seeing a short bounce, but again, remember, they just pumped $250 billion into the banking system to support the stock. So that's completely understandable to see a little bit of a bounce in yields as they push massive money into the stock markets to try to protect businesses and ensure that everyone has a job. So you can understand why the governments are taking the actions that they are, but to be fooled by it, I highly doubt that we've seen the bottom in how low yields can go in Germany and thus in the United States. So we remain long the TLT, which means we expect these yields to travel lower and for there to be a period of rate cuts. And in this chart, we're looking at the yield curve. And again, the banks rely on a yield curve where it costs more for the U.S. to borrow long-term, and it costs less to borrow short-term. And anytime this becomes inverted, that just means that you get paid more to borrow in the short term, or to lend in the short term. You get paid less to borrow in the longer term, which you can see in the first portion of the yield curve. And don't forget, the Fed is artificially keeping that front-end yield much lower by purchasing a minimum of $60 billion a month of the T-bills, which are the 1 month, 3 month, and 1 year treasuries. So this would be much higher without artificial help from the Fed, and the bond market is predicting that the Fed will cut rates, and that's why the notes on the 2-year, 3-year, 5-year, and even the 7-year, and even the 10-year are trading at a lower yield than your 1 month, 3 month treasuries. So bond market is calling BS on the stock market, and that we have rate cuts and slow growth ahead. And again, this is probably all due to China and its coronavirus breakout. All right, guys, that's the end of today's update. Normally we look at more news, but I did have our boot camp module today where we learned a lot about call options, specifically about what happens to the value of call options as volatility affects prices, time premium, what's the perfect strike, and the perfect expiration to pick based on how far you think the asset will travel and how long it will take. And it's surprisingly much different than you might anticipate. So again, I really hope you guys will consider subscribing to our YouTube channel, liking the video, leave a comment, click on the link in the right-hand corner to take a free 7-day trial for our options program. There are huge advantages to owning these assets with a covered call on top for income and a put option below for insurance and downside protection. We do our best with our buy and hold portfolio to accomplish the same. It's just not possible. The option market gives you an unfair advantage, and it also gives the ability to get a 10-to-1 risk to reward ratio betting down on China right now. The trade we just issued today risks $25 to make $275, and we just need EEM to hit the 40 price level from its current 43.80. Okay, that's a wrap. See you guys tomorrow on the webinar. And again, if you sign up for a free trial, we have a daily webinar with our entire crew who are trading these same alerts. So join us, and thanks.